Over the last 5 years, our Oak Harvest investment team has repeatedly discussed stock market cycles and stock market seasonality. Why? Because much of public market investing is repeated human behavior. In a real-world lesson in behavioral finance, as humans en masse tend to be creatures of habit, repeating behaviors time and time again. This has led to the saying, history may not repeat, but it often rhymes. Drop me a comment on some cycles you think repeat themselves below. Historically, we try to publish these pieces on cycles and seasonality in front of these time periods, when we see opportunities to exhale, not get FOMO, and wait on better tactical opportunities, or on other occasions, like in the fourth quarter of 2020, pre-2020 presidential election, to accelerate your stock buys when volatility is high and when the markets are down, or as Charles would say, acting squirrely. Summer seasonality in the stock markets is historically a real thing. The data confirms it. It shouldn't come as a surprise to investors as such. And we've discussed this in prior videos. America is a consumer-led economy with well over 70% of our GDP dependent on consumers and their consumption of goods and services. This compares to less than 30% of our economy driven by manufacturing and shipment of goods and services. So what happens during the summer? Our consumption slows as we go on late summer vacations and prepare for an upcoming school year. Because of this seasonality in our consumption habits, it bleeds into corporate earnings, GDP statistics, and historically, monthly stock returns. Which brings me to the title of this week's episode. Summer stock seasonality? It's a real thing. Before you press onward, please take a moment to click on both the subscribe and notification bells so you'll be alerted when our investment team uploads our latest content. Or better yet, give our Oak Harvest team a call at 877-896-0040 to speak to our team and set up an initial consultation with an Oak Harvest advisor to discuss your personal financial situation. We first discussed our third-year presidential cycle bullish stance early the fourth quarter of last year, when the S&P 500 was near 3,600, and the vast majority of strategists were saying new lows were coming, a recession is just around the corner, or worse yet, we're going to crash. Just pull up any Jeremy Grantham from GMO video for the last 10 years, any market call from the Heisenberg Group on Seeking Alpha, or frequent black swan commentators on CNBC like Nassim Taleb. You'll see what I'm talking about. Eventually, one of them will be right and take a victory lap, and the financial press will laud them that they nailed it. However, they've all been consistently wrong for almost 13 years, and their advice has done you no good in reaching your long-term financial goals, or even short-term tactical trading if that's what you do. Here's Taleb's latest dire forecast. I'll drop a link in the description if you want to watch it, or just watch any of the ones he's promoted over the last 10 years. They're all the same as far as I'm concerned. The last 3 quarters have been super strong in the stock markets, with the S&P 500 up almost 20% year to date. But it hasn't been historic, like many strategists who've been cautious or negative the whole way up have led you to believe. In fact, it's been quite normal for a third-year presidential election cycle combined with a Federal Reserve that is slowing its interest rate increases. During June and July, the rally in the S&P 500 returned a spectacular 9.8%, with July's 3.1% return up almost double the average July of 1.7%. Take a look at the monthly seasonality of the S&P 500 during the third year of a presidential cycle. This data was compiled by Steve Supmeyer's group at Merrill Lynch. As one can see, we have now left what has historically been the high odds for a high positive return period of the first half of the year. That ended with July, and we've now entered what should be 3 or 4 months of some negative monthly returns and higher volatility at worst, or sloppy, choppy sideways behavior, a general consolidation, and net little to no price appreciation in the S&P 500 at best. Does that mean you should blow everything out of your portfolio to avoid what could be a sloppy time period? No, if you're sticking to your long-term financial plan. Why? Because the economic and Federal Reserve and stock market cycle work still favors us approaching our old all-time highs of 4,800 later in the year and exceeding them in the first quarter of 2024. Just reminding investors, some of the data we shared in the fourth quarter of 2022 when many were suggesting dire economic and stock market outcomes because of the poor first through third quarters of 2022. The data, as presented by Merrill Lynch, once again said, buy stocks for a strong 9 to 12 month run. Recall, back late in the third quarter of 2022, the United Kingdom pension funds were blowing up, causing some wild short-term swings in bond and stock markets. They were required to cover mark-to-market losses with their lenders or derivative market counterparties. Dramatically higher interest rates throughout 2022 generated large mark-to-market losses for pension funds that, combined with higher volatility, triggered some large margin calls. We wrote about this event and made the comparison of it to the tequila Mexican debt crisis that Alan Greenspan caused in November and December of 1994, as he raised interest rates swiftly back then to offset inflation. The data shows that these events happen near the end of interest rate cycles, right before central banks slow their rate moves, and investors shouldn't wait to see inflation, as reported by government economists, plunge, or wait for interest rate cuts, because waiting would cause you to miss much of the move higher in stocks. The S&P 500 closed the third quarter of 2022 around 3585. The median three-quarter return from the third quarter of the second year presidential cycle to the end of the first half of year 3 was 17.7%, which equated to 4220. The S&P 500 did better than that, this time returning 24% over the 9 months to 4450. Even more interesting to me is the median 12-month return, which would end September 30th next month, is an impressive 22.2%. That return would equate to 4517 on cash S&P 500. As of this script being written on August 3rd, the cash S&P 500 stood at 4517. While the overall stock market accelerated above our very short-term forecast in July, pulling forward some of our expected 2023 returns into earlier months, our team still remains positive on the total return and outlook for the rest of the year, and would use seasonal weakness in August through mid-September, call it mid-October, as an opportunity to add to stock positions. While many other strategists, advisors, and newsletter writers have called the stock markets a bubble for years, we still see good investment opportunities in the public markets. True bubble-type equity action, and its popping, in our opinion, would come from higher levels in the stock markets later in the cycle. In fact, if one is just a chartist viewing equities as pictures of supply and demand, independent of valuations and fundamentals, and one looks at many of the monthly setups of some recent technology AI stocks and their moves, one might come to the conclusion that if, and I do mean if, we're in an AI bubble, call it Internet 2.0, we're only halfway there in time and price. To remind investors who haven't studied it or didn't live through it, these were the monthly returns of the NASDAQ composite into the internet bubble peak in February 2000. Here are the tables. The NASDAQ had gained over 125% in the year and a half leading up to the peak in the internet bubble, and included monthly returns, not annual returns, but monthly returns of 13, 10, 12.5, 14, 12.5, 22, and 19%. Toward the end of bubble-like moves, stocks usually move parabolically, meaning each successive month has a higher return than the previous month, until buying is exhausted and short selling has collapsed. They are a lot of fun on the way up, because every buy looks smart and every sell looks wrong, but they always end the same way. Hardship for those who get greedy, stay too long, and don't recognize the peak, reversal, and downward momentum that usually lasts quarters and years, not days and weeks. At Oak Harvest, we currently manage broadly diversified equity portfolios that balance risk and reward for our clients. We don't concentrate our clients' money in only one or two sectors, seeking to hit a grand slam. We try to hit singles, doubles, and occasionally a homer if someone makes a mistake and we find a stock at the right price at the right time. For those investors who are less optimistic and don't like as much risk-taking, those investors seeking higher dividend income that grows, those investors willing to forego some potential price appreciation in favor of lower volatility, we have a dividend growth equity model. For those investors who are in a much more optimistic camp, seeking long-term price appreciation, which does carry higher expected volatility without the focus on dividend income, we have a blue chip growth equity model. The overall tools our advisors and financial planners use are usually a combination of market and insurance-based tools to meet your retirement goals. Our investment team is busy working on some new and highly unique equity models for our advisors to use as tools for our clients in the not-so-distant future. Stay tuned. The future and the stock markets are always uncertain, and that is why our retirement planning teams plan for your retirement needs first and your greed second. Give us a call here to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. From Charles, James, myself, and the rest of the team here at Oak Harvest, have a blessed weekend.